You see, the frustration comes from
when you
on this WTV special on putting your mind over the market. I'm Jared Levy, Chief Options Strategist here on Wise Trade TV, and using psychology in today's market is not an easy thing to master. It takes a lot of discipline and skill to become a consistent and successful trader. Here to talk to you about what you need to do in order to put your mind over the market is Mark Douglas. Mark has been a successful trader since the 80s and has written 2 books on trading psychology, both Trading in the Zone and The Disciplined Trader. You've heard me talk about them many times here on WTV, and he is here today to help you become successful traders. Mark, good morning. How's it going?
Good morning, Jared. Glad to be here, and I hope I can be of assistance to some of your traders who are viewing right now.
Mark, you know, last time we were together was at Wise Fest, and had a lot of fun. I'm really excited you're here with me today.
Thanks.
So let's get started. First of all, you know, one of the main issues that I see all the time is that people don't use their method to its full potential. In other words, there's a negative correlation between what the trader ends up with and what he could have had if he just followed his methodology. Right. In your DVD program, you refer to this as the profit gap. This is a problem. You refer to it as the profit gap. And I think it's one of the least understood concepts of trading. Can you address this a little bit? This profit gap?
Yeah, that's actually a really good place to start because I think that more than anything, what your viewers want or what your customers want are consistent results. They want to be able to produce an income that, you know, that they can rely on from their trading. And I'm sure that you know, many of your viewers have already realized that getting a steady income is not such an easy task.
Yeah, and everyone seems to get trapped thinking that because trading is easy.
Right.
Or because it's easy to find yourself in a winning trade, exactly. Which many people do.
Right.
You know, that they think it's also easy to become a consistent winner.
Right.
And you know, it took a long time before it actually dawned on me that winning and being a consistent winner are 2 completely different animals, 2 different things. And in some ways, there isn't even a relationship between the 2.
It almost seems like there's no relationship between the 2.
Yeah.
That's what you're saying, right?
Yeah.
Yeah, that's a real hard mental barrier to break through. Mainly because, you know, it's so easy to find yourself in a winning trade, and that because winning actually requires no skill at all. In other words, unless you consider that, you know, the being able to click a mouse button or, you know, tap a pad is a skill. Right. And we don't have to have a reason or good reason or even actually any reason to put your cursor on the buy or sell button and then immediately find ourselves in a winning trade. And it could be a monster of a winning trade. And what did it take? What kind of what kind of skills did it take to actually experience this? Absolutely none.
Yeah. So it'd be natural to take the leap from, well, if it's this easy to win, it can't be that much harder to make a steady income. Like you said, it's that easy to click the mouse and for me to sit there and make $5,000 or $10,000, then it must be pretty darn easy for me to sit there and make a living out of this. You know, and that's what I thought for a long time, but that is not the case.
No, and that's exactly how I started out too. And I know, not unlike a lot of other people who are willing to, let's say, give up a real high-paying career to be a trader because they thought it couldn't be that hard.
So what makes consistency so challenging? What's the big hurdle there?
Well, obviously we're gonna get into that, but at the most general level, I'm gonna say that it requires learning the type of skills that people just simply aren't used to learning.
Mental skills.
Mental skills, yeah, exactly. In other words, it requires mental skills. Most people assume that because their technical method gives them a signal to get into a trade, that if the method produces a high percentage of winners, it will equate to a consistent income, not taking into consideration that the proper execution of those signals requires mental skills.
Give us an example of this.
Well, take for an example, you know, a high school basketball player who, you know, he'll go in the gym and practice throwing his free throws, maybe for even 2 or 3 hours a day. It wouldn't be unusual for him to be able to hit 50 in a row, would it? I mean, that's
you
not
see that all the
out
time.
of the realm of reality, right? Okay, so the problem is that could he even hit 2 in a row if the circumstances were he was in the final game of the NCAA championship, his team is down 1 point, there's only a few seconds left on the clock, and he was just fouled.
Changes everything.
Yeah, under those circumstances, without the appropriate mental skills, hitting either one of those free throws is very unlikely. And regardless of how well someone could do it in practice, most people would choke.
So really the skills you're referring to, what you're talking about, Mark, is actually staying focused on the process, staying positively focused on the process itself, in this case, of throwing the ball, in our case, obviously, of trading or following your method, right, and not being worried about blowing it, about the consequences of what could happen if this trade goes wrong.
Exactly right. Just like what I'm going through right now. Trying to stay focused, yeah. Trying to stay focused on the process of this presentation and not blowing it.
Well, you're doing fantastic, by the way.
Anyway, you know, with trading, we may have a technical method telling us what to do and giving us the potential to generate consistent results. But like the basketball player, without developing the appropriate mental skills, it's unlikely we'll be able to do what our method, our trading plan is indicating without making a number of potential execution errors. In other words, to stay positively focused on the process of trading by doing exactly what we need to do, when we need to do it, without hesitation, reservation, or fear.
Okay. That's interesting.
So you see, no matter how good a technical method is at generating winning trades, turning those winners into a consistent income requires the ability to do or not do some things that the method itself can't help us with. For example, our method can't force us to predefine the risk of getting into a trade. Or if we do predefine the risk, our method can't force us to take the loss that ends up turning into a bigger loss. Right. And you know, that's happened to everybody. Okay? Our method can't prevent us from moving a stop closer to our entry point where we get stopped out and the market trades back in our favor. Our method can't prevent us from hesitating and getting in too late. Or our method can't stop us from jumping the gun and getting in too soon, where the signal to actually get in never really develops. And our method can't stop us from getting out of a winning trade too soon and leave money on the table. Nor can it prevent us from letting a winning trade turn into a losing trade without having taken any profit.
I know that all of our traders have experienced these issues. I know they have, and I think really what you're saying is that the methodology, and this methodology, folks, what we're talking about, we say the word methodology is the Wise Trade software, that's our method. And it can give us winning trades. We've seen, I know all of you have had winning trades, but it cannot give us consistent results if we're susceptible to making the kind of mental errors that you're talking about here. Okay?
Exactly right. Yeah, that's exactly what I'm saying. And all the mental errors I just listed are the result of thinking, believing, or assuming that our technical method is telling us what's going to happen next on a trade-by-trade basis. and not understanding that technical methods aren't designed to do that. Right. Technical methods and patterns are designed to put the odds of success in our favor over a series of trades. It may not seem like it on the surface, but there's some profound psychological implications here. What this means is the outcome of the signals generated by any technical method on a trade-by-trade basis are unique and random. In other words, there's no way to know in advance what the outcome to any particular signal will be or what the sequence of wins or losses will be over a series of trades.
It's a mouthful. and I understand what you're saying. And I think, we need to, first of all, know that many of our viewers out there are experiencing the same sort of thing, okay? And they're probably going to have some trouble grasping this concept that by accepting the randomness of these outcomes, they can produce consistent results. That's an odd concept.
Yeah, but that's exactly what I'm saying, Jared. I know it's somewhat of a paradox to think that events that have a random outcome can produce a consistent result, but think about it. This is the principle that's been used by casinos for hundreds of years.
Right.
Technical methods and patterns will give the individual trader the same kind of advantage the casino has over the individual player. If the trader can think about it from the proper perspective. On the other hand, if a trader who has generated his signal from a technical method hasn't learned to integrate this principle, this randomness principle, into his trading regimen, he'll undoubtedly find that trading can be one of the most frustrating, if not exasperating, endeavors he's ever chosen to undertake.
And I know there are a lot of viewers out there who may be experiencing frustration. In fact, I know there are definitely viewers who are experiencing frustration, but I'm not sure if they're making the connection that the reason because, they don't believe in this randomness principle where you can generate consistent returns by looking at the outcomes of their trades as random and unique. Right. They have to be able to view that as random and unique. That's, I think, the big issue.
No, I know, and that's why we're here explaining it right now. You see, the frustration comes from our expectations. It's from expecting something from our technical method it just can't do. Technical methods define and identify patterns in collective human behavior. Right. Now, the patterns definitely exist. They repeat themselves over and over again. The problem is the outcomes don't always correspond with the patterns on a trade-by-trade basis. So what I'm saying is that, yes, we have patterns, yes, and they repeat themselves over and over, and our minds just naturally think, well, I have a pattern that's consistent, I should have an outcome that's consistent with the pattern, right. And that's not what I'm saying at all. What I'm saying is that there doesn't have to be a relationship between the outcome and the pattern.
Right. So, and if the last trade was a winner,
right.
This trade, even if the charts are the same,
right.
Even if we've got the same exact signal, the same looking chart, there's no guarantee that this trade is going to be the exact same as the past one.
Exactly. In other words, this trade, the trade I'm in right now, could turn out to be a winner. And does that mean that the next trade is going to be a winner? Absolutely not. This trade I'm in right now could end up being a loser. And does that mean that the next trade is going to be a loser? No, absolutely not.
Yeah. This is interesting. I mean, I'm trying to... For us up here, the goal, the main goal is obviously to take these concepts and reduce them down to the most simple of terms. So, let's again back up here for a second. There are traders out there using WiseTrade every
right.
single day. They're getting the same exact patterns, okay? But what you're saying is even though the specific criteria is being used to identify the pattern, okay, for each signal, same criteria,
right.
same formula, same everything.
Right. The chart pattern can look exactly the same.
Yeah,
everything.
Right. The outcomes to each signal have no relationship to one another.
That's right. That's exactly what I'm saying. That there's a random distribution between wins and losses over any sequence of trades that you might look at. And so, and again, this is a very difficult concept to grasp, but it's really the traders who have grasped it, let's say, and learned how to think in what I call probabilities. Okay. They're the ones that don't experience the same kind of emotional trauma that the typical trader does because they're expecting something that just may not happen. So for an example, if this trade's a winner based on this particular trade I'm in right now, based on the exact same criteria that, you know, or let's say I'm in a trade right now, or I'm getting into a trade right now, and the exact same criteria exists in the market that did the last time, I'm going to naturally expect it to be a winner if it was a winner the last time. Or I probably will naturally expect it to be a loser if it was a loser maybe the last time, or we had 2 or 3 losers in a row.
And this could be a source of frustration for traders.
Oh, absolutely. In other words, and that's exactly what happens. It is a source of frustration, because if I'm expecting it to be a winner and it turns out to be a loser, I'm going to be frustrated. Not only going to be frustrated, I'm going to be disappointed, and I may even feel betrayed, depending on how much kind of energy that I put into the idea that the trade is going to be right.
Well, how do we get over that? I mean, how does a trader take, okay, so I've done all the things right. I've got my charts lined up. I've done everything I was supposed to do. How does the trader at least begin to accept these sorts of things, or how do they begin to remedy these issues?
Well, we kind of have to get into the nuts and bolts of this, of just exactly how the markets work, because I think that one of the big problems, one of the reasons why people have such a difficult time with this, is because their initial exposure to the markets themselves is through electronics. Right. In other words, through electronics, there's a real disconnect between what you're actually participating in and what's causing you to want to participate in the first place. In other words, markets started as exchanges, right. And there were and so when you traded at an exchange, so you know that all prices are people-generated events.
Correct.
They are, and see, this is what people have to take into consideration. Everything happens because of what people believe. When you look at the nature of trading and break it down to its simplest components, what you have is everyone trying to do the same thing. There is no possible way that any of us can make money as traders unless we can buy low and sell high, or sell high and buy low.
Correct.
Is there any other way, Jared?
No.
No other way.
In every market.
In every market. So basically, everyone's trying to do the same thing, are they not?
Yes.
Everyone is doing the same things. Now, the reason why we have price movement is because everyone has a different idea about what is high and what is low. Okay? Right. So now I get exposed to a technical method. Now, what does this technical method do? And this is the relationship that people need to grasp. If they grasp this relationship, then they can grasp this idea that you can take the same set of criteria and end up with random results. And it's this. It's like what people realized years ago is that you can take data points. In other words, data points, meaning what you're doing is you're translating the human behavior, the human belief in. If I'm going to buy
into something visual.
What's that? No, it doesn't have to be visual, but it's like it could be. Yeah, it started out being visual. It started out being chart patterns based on bar charts. But what you do is that if I'm going to buy, it's because right now, let's say the last price is 10, and I put in an order to buy something at 10, okay? It's because I believe that the market's going to go to 11, correct, or it's going to go to 12. Right. Certainly if I thought or I believed it was going to go to 9, I would wait, would I not?
Correct.
So the reason why I'm buying at 10 is because that's what I believe. In other words, all price movement is based on people's belief about what's going to happen in the future.
Now you said to me in a conversation we had yesterday, obviously we as individual traders are not large enough in our accounts to move the market.
Exactly. And
okay.
So this is the next connection that people have to make, is that since all price movement is based on people's conviction or belief about the future, how do prices actually move? For an example, when you put in an order or I put in an order, I don't trade at a level where I can actually move prices. But what the typical screen-based trader doesn't understand is that there are thousands of traders out there who do move prices, and that it is their intention to move prices. Or you can have a large group of traders coming into the market and then cause prices to move. But what actually has to happen for prices to move is this, is that if the last price of something is 10, for the market to actually move to 11, all the offers have to be taken out, meaning that, or move to 12, all the offers at 11 have to be taken out. So in other words, people who are trying to sell at 11, they have to get their orders filled before it can get to 12. Okay. Well, for someone to actually bid it to 11 or bid it to 12, they are doing the exact opposite, and this is really critical. They are doing the exact opposite in that moment of what it takes to be successful. Okay. They're not buying low, they're buying high. They're buying high relative to the last price. Or buying higher relative to the last price.
So how does understanding this concept, how does understanding what moves the markets help our traders to take it to the next level? How does, I mean, is this the first step for them getting control and understanding how the markets work and getting a grasp?
Yeah, they definitely have to understand. They have to understand how prices move, because when they understand how prices move, then they'll understand how their technical method relates to this movement. Because what technical methods do, whether it's a visual pattern or you know, moving averages or any wise trade or whatever, you're using mathematical formulas. Okay? You're taking data points. In other words, you're taking what people believe about the future, transforming them or transposing them into a data point. As a price over time, okay, or with volume. There's any
or a fresh cross.
Yeah, there's any number. That's what it ends up being, is a fresh cross. But I'm talking about the actual mathematical formula that makes the fresh cross. Okay. So there are any number of variables that go into this equation. Now, what people have found is that, and this is here, what people have found is that using these data points into certain types of mathematical equations, you can find patterns in collective human behavior. And what these patterns mean is this: is that when this set of criteria, okay, is present in the market, that there's simply a higher probability than not. In other words, there's a higher probability, or what I'm going to call an edge, a higher probability of one thing happening over another, that other people are actually going to come into the market and bid it higher from here or offer it lower from here. There's just, in other words, when the pattern is present, this collective pattern is present, it will repeat itself. But the problem is that it repeats itself on a random basis, because even though the actual mathematical criteria is exactly correct or exactly the same.
You can't, mathematical models can't predict human beings.
That's right. Mathematical models can't predict who the actual individuals who are going to come into the market and actually do it. In other words, it takes someone to do it. When you put on a trade, if you're not going to make your trade a winner by bidding the market, if you bought something by bidding the market, you know,
using all of my money.
Using all your money to you know, if you bought something at 10, you could actually wipe out all the offers and bid it to 11 or bid it to 12 or bid it to 13. Now, if the price is at 13, all the trades that you put on at 10 are winners, right?
Yeah, but I still bought it at 11 and 12.
Yeah, but well, you're averaging up. But the point is, all the trades that you put on were winners. You actually made yourself a winner.
That's correct.
But what I'm saying is that when you don't trade at that level, we are actually obliged to other traders to come in to buy something at a worse price than what we thought was low to make us winners.
So what you're saying is most of us out there are dependent upon someone else to move the market for us. We're trying to identify that pattern, obviously using the Wise Trade software to find those common entries. But again, it's a random event. Well, we're putting the edge, you said, in our favor.
Yeah. Jared, when you put on a trade, okay, when you put on a trade, do you know who, now what we've done is we've reduced the market down to these terms, okay, that it takes someone else to make us a winner, right?
Correct.
Okay. When you put on a trade, do you think about who that might be, who might come into the market to actually make you a winner?
No, of course not.
Yeah, no. And if it turns out to be a winning trade, do you know who those traders were, or who that trader was that actually made you a winner?
No.
Is there any way to know?
No.
There might be, but it'd be pretty hard to find out, right? I mean, you could go to the clearing firm, you know, the firm that clears the
bottom line is
bottom line. Yeah, exactly. So what I'm saying is that when the pattern presents itself, like, okay, I have an edge here. When the pattern presents itself, we don't have any idea of who is actually going to come into the market to do this for us. And so there's no point in analyzing. There's no point in judging. There's no point in trying to figure out whether it's going to work or not. It would be like, for an example, if I said to you, Jared, I'm going to give you a coin, and this coin is weighted in a way where it's going to come up heads 70% of the time. Right. Now, just because I know mathematically and statistically that this pattern of coming up heads 70% of the time exists, is there still any way for me to know the actual sequence to heads to tails?
Of course not. It's an infinite.
Well, no, I'm saying, do I know the sequence? In other words, I'm going to flip the coin 100 times, and statistically it's going to come up heads 70% of the times. I still don't know which flips are going to come up heads. Which flips are going to come up heads. They say which flips. It's not the times. Right. Which ones? In other words, we flip the coin once, it comes up heads. Flip the coin twice, it comes up heads. The next one's tails, the next one's tails, the next one's tails. In other words, we could have streaks of heads or tails, okay? We could have streaks in there. The point that I'm making is that there is no way to know the actual sequence.
But at the end of the day, we know we have 70%.
So what that does, that obligates us, if we want to be able to trade our methodology in an effective fashion, to be able to utilize this methodology in a way where we can extract the maximum amount of profit that it makes available to us based on the pattern that it identifies. We have to do it in certain ways. In other words, our mind has to be free to be able to execute these trades without making trading errors. And the trading errors come from believing that because the pattern is present, that it's going to give me a winning trade on this one. This trade is going to be a winner.
You can't think that way.
No, you can't think that way.
You can't think that
That's the way the typical trader thinks.
Right.
The typical trader thinks, I'm not going to put this trade on unless I think it's going to be a winner. Or why would I do it? And it skews our expectations. See, it messes our expectations up.
Let's back up a couple seconds here. There's some great stuff here, Mark, and I hope our traders are getting all of this. You're basically saying, and this makes a whole lot of sense to me, and I hope it's getting through to you guys, we have a tool that gives us an edge, whatever it is.
Right.
Even if that edge is 2% or 3%, I don't know if we can...
No, it's more than that.
Maybe more than that.
What do you mean more than that? It's a lot more than that. It's far more than 50%.
Well, I was saying greater than 50. Okay. I was using edge is defined as...
I see.
Yeah.
Okay.
So maybe 55 or 56% of the time.
Right.
Let's just say...
And the thing is, it doesn't even have to be 50% to actually make consistent money. That's what people can realize, too. That depending on what the ratio is between what you have to risk to find out if a trade is going to work and how much profit it generates when it does, you don't even need a 50% win-loss ratio. Right. As a matter of fact, back in the 80s, there are, one of the most famous traders from the 80s, Richard Dennis, on a percentage basis, 95% of his trades were losers. 95%. But the 5% that were winners were monsters. And he was able to put on trades at a 95% loss ratio and make, at the most at one point, I think around 1987 or 1988,
now,
he had $400 million.
Is that using his edge or his money management, or a combination of both?
A combination of all of it.
Okay.
And see, one of the things he did too, and this is something I ought to really qualify with, he would use orders to actually probe the market. See, there's one of the things, I don't want to leave what we're doing right now, but I'm going to just kind of divert just for a moment,
okay,
and so that people understand that one of the first things to be a successful trader that you have to learn, other than the fact of finding a good edge, meaning something that puts a pattern, a collective pattern that your edge identifies, that puts the odds in your favor, right, that there's a higher probability of one thing happening over another once this pattern is present in the market, is that you have to learn how to think in probabilities. In other words, you have to get your expectations aligned with the way the market actually exists.
Right.
And when you do, in other words, when you learn these kind of mental skills and you're able to execute your trades without fear and without hesitation, without analyzing, or even without thinking for that matter, because you don't need to think. I'll give you an example. A professional trader, what a professional trader thinks about when there's an edge present is, does he think about whether the edge is going to work? Absolutely not. Because he knows, he has learned, there's no point. Right. There's no point in analyzing or judging or building a case for or against whether that trade is going to work, because he understands the human component. Okay. Right. But what he does think about is he thinks about the risk. How much do I have to risk? How far am I going to let the market go against this position to tell me that other traders are either going to come into the market and make me a winner or not? And he also has a plan for how he's going to take profits.
Right.
But the typical trader, what does the typical trader do?
They don't have a plan.
Well,
or they think about the trade too much. They think about, is this going to be a winner? Is this going to be a loser for me?
The exact opposite of the professional.
So what the professional does is basically...
And then once they make up their mind that it's a winning trade, they don't predefine their risk, do they?
Right.
And they also don't have a plan to take profits because they think
it's going to be a winner.
It's going to go on forever.
And I want to talk about that. We're running up on the break here, but I want to talk about that on the other side. But what you're saying is the bottom line is the professional sees the entry. He sees the pattern, whatever it is, the edge, enters in, not thinking if I'm going to win or I'm going to lose, but has a money management strategy in place, knows exactly how much he wants to win or is willing to win and how much he's willing to lose or risk.
Right.
Exactly. Now, does he put a cap on the upside? Does he put a cap on his win side?
It's not a matter of a cap. It's a matter of his assessment of how much potential there is. Okay. In other words, see, the problem is on a winning trade, we're obligated in a sense to make these never-ending decisions as to what the risk to reward ratio is. In other words, as the market's going in my favor, what's the risk of finding out that it's going to go further? And that's why so many professional traders or people who teach trading advocate scaling out of positions.
Right. Mark, this is all great stuff. We're going to have to wind it up. We got to go to a break, guys. It's already time. As I said, for a break. We'll be back with much more with Mark Douglas here in 3 minutes. We'll see you soon here on WTV. Welcome back to the WTV special on putting your mind over the market. I'm Jared Levy. Mark Douglas has been talking about psychology in today's market. Mark, let's continue with our conversation we left off with. We were talking when we left about the flip of a coin. Right. And you said that you had a coin that was actually weighted on one side. You gave an example how a coin was weighted on one side, and over a series of flips, that coin had a 70% chance of, in this case, landing on heads. Right. Whereas in our software, we give you the edge, and maybe with our software, you have a better chance of being right or having a winning trade if you get in on a certain pattern. Right. You also talked about how
it's the word right that's really critical here. Okay.
Right.
It's the word right. In other words, what people need to understand is how does believing in a random result affect your expectations? Because see, what we don't want is we don't want to get into trading with the possibility of being disappointed, or the possibility of being dissatisfied, or being even betrayed, because a lot of traders feel that way. They really feel betrayed. And the problem is that when that potential exists, it has the effect of affecting the way that we see market information in detrimental ways. Because, in other words, all of us have these mental pain avoidance mechanisms that affect our perception of information. Right. So, for an example, if I'm in a losing trade, and I got into this trade thinking I was going to be right. Okay. In other words, I did all my evaluation, I did all my analysis, I did my work, I built a case. Right. It's like as the market's moving against me, I'm going to have the tendency to focus on information that tells me that I'm right and ignore the information that tells me that the market is actually trending against me. Okay. In other words, I can identify a trend, but I won't be able to identify that trend if I'm putting an inordinate amount of significance on the information that's telling me that I'm right, as opposed to ignoring the information that's telling me that I'm wrong. And see, and overall, if we want to be consistent, the principle that we need to keep in mind is that to be consistent, we have to cut our losses and let our profits run. We have to make more on our winning trades than what we lose on our losing trades. And the problem is that if I'm susceptible to being disappointed or betrayed, meaning I get into a trade, expecting it to do what I think it's going to do, that I'm going to have this tendency to distort market information that causes me to hang on to my losers. And in a winning trade, what will happen is that instead of letting a winner run, markets don't go straight up. In other words, if I'm in a long trade, right, I would like the market to go straight up, but they don't. They go up and they come back and they come, and it's the retracements we focus on instead of the fact that the market's still trending in our favor.
So what you're saying right now, basically, is I found a stock, for instance, that I love. The stock just had a great news story. The charts are the same as the other stocks that I've traded, but just for some particular reason, I feel great about this stock. Don't know what it is, but maybe they had some great news out, and I feel that stock starts to go against me. You know what? Based on the news that's out there, based on the special feeling I have about this stock, I continue to hold my loser. I continue to hold my loser until this thing draws down against me, and I'm in a major losing position. And I keep losing because I feel in my mind that I had some sort of special. This stock was special. Is that what you're referring to? Or?
Yeah, it could be anything.
Because I know traders do that.
Yeah, I know. It could be any variable kind of information that people latch onto. Okay. The thing that they have to understand is, regardless of the reason that they got into a trade, regardless of the reason, if other traders don't buy into that reason, or if other traders don't have another reason to want to buy at a price that's worse than yours. You bought the stock at 10. Right. Someone's got to want to buy it at 11. Someone's going to want to buy it at 12 and buy it at 13. And not only be able to buy it at 11, 12, and 13, and 14, they're going to have to take out all the offers, all the traders who think it's high. In other words, at 11, 12, and 13. And so if these people aren't coming into the market to do that, well, then whatever reason you thought you had might not be so good. Right. And so that's why it's so critical to predefine your risk before you even get into a trade. And that's why professional traders don't think about it any other way, because they know it takes other people. My reason might be great, but if someone else isn't buying into it, what difference does it make? It doesn't matter, because it's not a winning trade. And so, if we have this susceptibility to be disappointed, what it does, it affects our perception of market information in a way that doesn't allow us to cut our losses.
How do we make ourselves not susceptible? I mean, how can you shut off?
Yes, by changing your perspective on this, by really understanding. For an example, Jared, you ever played a slot machine?
Yes.
Okay.
Now, I don't like it.
You might, okay.
But I played it.
For whatever reason you don't like it, doesn't matter, okay? That's good that you didn't like it, because it might make the example even better, okay? Okay? You play a slot machine. When you put your money in the machine, let's say it's a quarter machine, okay? You put your money in the machine, you press the button, and the pattern indicating that there's a payoff doesn't show up. How do you feel?
No.
Well, do you feel betrayed? Do you feel betrayed by the machine?
No, not at all.
And why do you not feel betrayed by the machine?
It's just a random, it's
a random outcome. Okay. So in other words, you went into it with the belief that you know that you're participating in an event with a random outcome.
Right.
And as a result, your expectations about the outcome were in perfect alignment with the event itself.
My expectation, believe it or not, was to lose. I know this sounds crazy, but when I put the quarter in, I thought, you know what, I'm probably going to lose this quarter.
Yeah, exactly, okay? Because the odds aren't exactly in your favor. And what trading systems can do is actually put the odds in your favor in a way where we own the machine. Believe it or not. I mean, the whole role reverses if you learn to think about it correctly. In other words, if you understand that, so for an example, well, let me backtrack a little bit and say that most traders, if you compare trading to a slot machine, the difference would be that with a slot machine, we can't play until we've accepted the risk. In other words, we actually have to take our money out of our pocket and put